Oke, ya pagi ya. Selamat pagi, Bapak Ibu. Mungkin bisa kita mulai ya webinar ini. Good morning everyone. Good morning Nicholas, Billy, and Wai Chung, our speaker today. Selamat pagi Bapak Ibu peserta webinar pada hari ini. Perkenalkan, nama saya Ronald Sajuti. Hari ini saya akan menjadi moderator untuk acara ini. Sekali lagi, kita kan ada 3 sesi ya. Nanti yang berikutnya akan ada moderator lain. Jadi semoga webinar ini pada hari ini sama lancarnya dan sama bermanfaatnya seperti yang sesi pertama kemarin ya, tanggal 4 Agustus kemarin ya. Oke, jadi webinar hari ini merupakan sesi kedua dari webinar IFRS 17 Measurement gitu ya. Sesi pertama yang kemarin diadakan pada tanggal 4 Agustus, kita sudah membahas tentang LIC atau Liability for Incurred Claim gitu ya, LIC singkatannya. Informasi untuk sesi sebelumnya bahwa panitia sudah mengupload di link yang sama untuk template yang sudah berisi formula ya, karena banyak request dari teman-teman untuk video, untuk template yang berisi formula, itu sudah diupload untuk template yang berisi formula di link yang sama seperti yang materi yang sesi pertama gitu ya. Jadi ini akan mempermudah Bapak Ibu untuk mempelajari IFRS 17 gitu ya. Nah, hari ini sesi kedua kita akan membahas tentang LRC atau disebut singkatannya Liability for Remaining Coverage. Ini kalau zaman sekarang ini dia sebutnya mungkin kayak cadangan premi lah gitu ya. Kalau yang kemarin ini klaim gitu ya. Nah, sebelum acara dimulai, saya akan bacakan lagi tata tertib webinar pada hari ini seperti webinar sebelumnya. Yang pertama, serta harap merename sesuai dengan format ya, nomornya yang sudah dibagikan, nomor strip nama. Jadi misalnya kalau nama saya Ronald dan nomor saya 002, jadi nanti saya akan tulis 002 strip Ronald, itu untuk mempermudah nanti panitia untuk melakukan absensi. Ya. Yang kedua, peserta harap mengisi form presensi atau feedback melalui link yang akan dibagikan melalui chat nanti ya. Yang ketiga, untuk kelancaran jalannya webinar, kamera dan mic seluruh peserta akan dinonaktifkan. Pertanyaan nanti bisa disampaikan oleh Bapak Ibu melalui chat atau dalam sesi tanya jawab seperti yang sesi sebelumnya. Bahasa Indonesia boleh, kalau bahasa Inggris mah akan lebih mempermudah gitu ya. Nah, nanti jangan lupa juga di akhir, tolong Bapak Ibu jangan keluar dulu dari Zoom ini karena akan ada sesi dokumentasi. Nanti diharapkan seluruh peserta mengaktifkan kamera untuk foto bersama, ya. Nah, untuk yang hari ini, materi webinar pada hari ini itu juga Bapak Ibu bisa download melalui link yang sama. Nanti ada pilihannya untuk sesi kedua itu, dia ada di situ, bisa Bapak Ibu klik dan Bapak Ibu download. Cuman yang untuk ada formulanya belum gitu ya, seperti yang tadi saya lihat ya. Jadi nanti kalau bisa di-download, karena ini bukan, lebih tepatnya ini bukan seminar ya, kayak semacam workshop online gitu ya. Jadi akan lebih mudah kalau kita mendownload dulu, jadi kita nanti akan mempermudah kita untuk ngikutin workshop ini gitu ya. Oke. Mungkin Bapak Ibu bisa sambil klik-klik gitu ya. Saya akan bacakan dulu pembicara kita, CV-nya. Seperti sesi sebelumnya ya, kita ketahui bahwa pembicara kita dari Malaysia. Ada satu yang dari Indonesia. Jadi webinar ini akan dilanjutkan dalam bahasa Inggris. Saya akan melanjutkan dalam bahasa Inggris ya, Bapak Ibu ya. So, before we start, let me introduce our speaker. The first one is Nicholas Yeo. The same like the previous session. Has over 15 years experience in actuarial work, including life insurance, family takaful, general insurance, general takaful, employee benefit, pension, medical insurance, reinsurance, and insurtech startup. And then another speaker is Billy Tanuwijaya. From his name again, we know he is Indonesian. Experience implementing IFRS 17 in general insurance company in Malaysia and creating a PAA eligibility testing model for general insurance company to use. Okay, another one is Wai Chung, actuarial analyst. This is our new speaker today. He has 2 years experience in actuarial valuation, data analytics, IFRS 17 modeling for life insurance and general insurance. And then he involved a lot in multiple valuation project in Malaysia, Singapore, and Cambodia. He has also significant experience in ETL and data, managing database for valuation work, and IFRS 17 cash flow model. He also involved in a profit model project to comply with IFRS 17 requirement. Okay, Billy will give us some wrap up about from the previous session, and then he will continue about today's session, and other speaker will follow. By the way, don't forget, at the end of the webinar, we will have Q&A session. So please, Bapak Ibu, you can type your question in Q&A, dalam bahasa Indonesia boleh, dalam bahasa Inggris akan lebih membantu sehingga saya tidak perlu menerjemahkan gitu ya. Billy, are you ready?
Ya.
Okay, please, Billy.
Okay, good morning everyone. Ya, selamat pagi Bapak Ibu sekalian. Ya, untuk yang belum mengikuti sesi kemarin, perkenalkan lagi, nama saya Billy. Saya Actuarial Analyst di Nicholas Actuarial Solutions. Saya berasal dari Indonesia. Jadi selama 10 menit ke depan, sesi saya bawakan dalam bahasa Indonesia aja ya, untuk mempergampang Bapak Ibu juga. Ya, oke. Let me share my screen. Ya, oke. Jadi untuk hari ini kita akan bawakan webinar dengan topik Measurement in IFRS 17 General Insurance. Hari ini kita akan bawakan liability for remaining coverage for general measurement model. Jadi di tanggal 4 sebelumnya minggu kemarin kita sudah memulai sesi pertama kita dengan topik liability for incurred claims, cadangan klaim ya. Tadi sudah disampaikan oleh Pak Ronald. Ya. Oke, jadi untuk hari ini saya akan membuka saja rekap sedikit minggu kemarin kita sudah ngapain. Terus hari ini juga nanti sesinya akan dilanjutkan oleh Wai Chung. Dia akan menjelaskan LRC GMM for one account, dan nanti akan dilanjutkan oleh Nicholas untuk menjelaskan LRC GMM for whole portfolio. Ya. Jadi saya nggak mau berlama-lama juga, soalnya kan opening saya ya mirip-mirip aja sama minggu kemarin, dan minggu kemarin juga udah ada recordingnya, jadi saya bakal skip banyak. Jadi saya mau langsung ke sini aja, financial impact for the first year. Buat Bapak Ibu, kemarin di minggu kemarin kan saya bilang saya belum ngikutin perkembangan tax ya di Indonesia buat IFRS 17. Jadi saya baru baca lagi berita, baru ngikutin lagi, ternyata DJP sudah mulai ikut untuk discussion buat IFRS 17 ya. Ini bagus, jadi semoga DJP juga bisa mulai nentuin aksinya kayak apa sih yang bakal diperluin buat treatment pajak, buat treatment revenue dan treatment expense, nanti gimana caranya untuk menghitung pajak buat perusahaan asuransi ya setelah implementasi IFRS 17 ya. Jadi ini aja update yang bisa saya bawakan untuk what will happen for year 1 ya. Oke, jadi buat hari ini kita tetap masih fokus buat measurement. Kita nggak bakal bawain buat combination and separation, level of aggregation, recognition, modification and recognition, presentation and disclosure. Jadi kita bakal fokus buat measurement aja, buat ngukur liability of insurance contract, kontrak asuransi untuk incurred claims dan remaining coverage. Oke. Jadi buat minggu kemarin kan kita sudah membahas gimana sih cara ngitung LIC? LIC itu seperti yang sudah dijelaskan oleh minggu kemarin oleh Mingwei dan Nicholas. Kita harus menghitung fulfillment cash flow plus risk adjustment untuk menghitung liability. Gimana cara menghitung liability for incurred claims-nya? Yang consist of case reserve plus IBNR. Jadi kita harus project dulu lah ke ultimate, terus kita harus mendapatkan cash flow pattern-nya, habis itu kita harus discounting, terus kita harus dapetin cash flow pattern juga buat risk adjustment-nya, terus kita harus melakukan discounting juga. Jadi udah dijelaskan caranya dari pertama sampai akhirnya, gimana caranya supaya bisa sampai dapat full opening balance dari nol sampai bisa kebuka, dan cara subsequent measurement-nya juga sudah dijelaskan juga ya. Untuk hari ini kita bakal fokus buat LRC GMM. Nah, LRC GMM ini yang sudah default ya, soalnya udah dijelaskan panjang lebar cara pengukurannya dari paragraf 20-an berapa sampai paragraf 60-an berapa itu menjelaskan cara ngitung LRC GMM. Ya, jadi biasanya LRC GMM itu diaplikasikan untuk asuransi jiwa dan untuk asuransi umum yang long term. Jadi buat asuransi umum long term, contoh kan buat asuransi mobil ya. Asuransi mobil kan biasanya kalau kita beli mobil baru, pas cicilan itu kan harus di-cover sama asuransi mobil. Nah, itu kan cicilan kan bisa panjang tuh waktunya. Nah, jadi itu bakal bisa harus diukur dengan GMM. Tapi bisa juga untuk asuransi umum kita bisa memakai PAA, Premium Allocation Approach, yang applicable for some short-term contracts. Ya, untuk kontrak-kontrak yang setahun kita bisa pakai PAA. Tapi bisa juga untuk kontrak-kontrak yang long-term, yang panjang. Jadi buat yang contoh tadi asuransi mobil tadi itu bisa aja kita pakai PAA, tapi kita harus melakukan namanya PAA eligibility testing yang mengukur perbedaan antara liability-nya kalau kita hitung pakai GMM sama liability-nya kalau kita hitung pakai PAA, bedanya jauh atau enggak sih? Jadi kalau misalnya jauh, kita kan nggak boleh tuh pakai PE, jadi kita harus tetap pakai GMM. Tapi kalau misalnya deket, sisinya kayak cuman ya, contoh misalnya kita udah set 5% sisinya, ya udah kalau misalnya di bawah 5% ini ya kita bolehlah pakai PE gitu. Contoh. Nah, dan ada juga namanya VFA. VFA ini biasanya buat unit link. Nah, saya juga baru baca berita, ternyata di Indonesia asuransi umum itu mau jual kontrak yang pakai investment link. Ini menarik sekali ya. Sayang kita nggak cover ya buat webinar kita cara ngitung VFA ya. Tapi ini bakal buat lebih challenging juga buat perusahaan asuransi umum. Soalnya biasanya kan perusahaan asuransi umum kan buat LRC-nya biasanya kan pakai UPR atau URR ya, yang biasanya cara pengukurannya lebih dekat ke PAA. Jadi kalau misalnya nanti harus memakai investment link, harus menggunakan VFA, which means more investment to the system lah ya. Nah, ini juga harus diperhatikan ya buat Bapak Ibu ya. Menarik tapi ya. Oke, jadi buat hari ini kita bakal cover semua part di sini, TVFCF sama RE. Bapak Ibu mestinya sudah aware nih apa berdasarkan dari topik yang sudah dijelaskan oleh Mingwei dan Nicholas minggu kemarin. Dan di minggu ini yang baru itu adalah CSM, LC, dan insurance revenue. CSM itu untuk kontrak yang profitable, yang memberikan laba. Loss component itu untuk kontrak yang merugi. Jadi kita akan menjelaskan dua-duanya, cara menghitungnya seperti apa, kita bakal jelaskan. Dan cara menghitung insurance revenue untuk setiap kali valuation, gimana caranya. Dan kita juga bakal cover insurance service expense juga, of course, dan insurance finance income or expense. Insurance finance income or expense untuk discounting. Soalnya sekarang buat GMM kita perlu mengukur dengan discounting. Yang biasanya asuransi umum belum aware, apalagi GMM belum aware caranya seperti apa. Ya, jadi untuk hari ini, at the end of webinar courses, participants shall be able to calculate LRC using GMM dan prepare LRC account using GMM. Ya, jadi untuk sesi kedua kita straightforward, kita bakal fokus 100% pada GMM. Oke, jadi Bapak Ibu seperti yang sudah disampaikan oleh Pak Ronald, sudah boleh mendownload dan membuka Excel yang sudah kita publish untuk sesi 2. Sesi 2 ini ada 2 Excel seperti minggu kemarin, cara menghitung untuk one transaction entry dan untuk whole portfolio. Nah, jadi Bapak Ibu sudah boleh buka Excel-nya. Nanti Wai Chung dan Nicholas pas saat menjelaskan, Bapak Ibu juga bisa langsung ngikutin. Bisa langsung masukin formulanya biar bisa langsung diaplikasikan ya. Nah, untuk full complete formula kita bakal publish next week buat sesi 2. Dan juga dengan PAA. Excel PAA dan slide-nya juga untuk PAA ya. Jadi Bapak Ibu sudah boleh buka dan sudah boleh siap-siap ya. Oke, jadi dengan ini saya akan pas ke Nicholas ya. Nicholas, you may start your session.
Selamat pagi ibu-ibu, bapak-bapak. So today we will start to focus on liability for remaining coverage under GMM. So the two things that we will introduce today is a contractual service margin or CSM. So when the present value of the inflow is more than the present value of the outgo, so that means the insurance contract is profitable. So when we expect to have profit from the contract, we will set up a contractual service margin (CSM), which is also in technical terms is the expected unearned profit. It is expected because we do not know whether this profit will really materialize in the future, and it is unearned because in the first day we calculate the present value. So, but this is on the first day, so we do not want to recognize all the profit in the first day. We want to recognize the profit over the duration of the contract. So we need to set up this CSM to ensure that there's no profit or loss at the inception. This is one of the key feature of the GMM. On the other hand, if the PV inflow is smaller than the PV of the outgo, so that means the contract will be loss-making. IFRS 17 requires that the loss-making contract all the losses will need to be recognized as an expense in the income statement at inception. So the standards say if you make profit, you need to spread it over time. If you lose money, you need to recognize it immediately. So if you look at this chart on the right-hand side, last week we have covered these three gray color column here, which is the liability for incurred claims and the present value of future cash flow and the risk adjustment. So this week we move on to the liability for remaining coverage. So this LRC is split into two parts. One part is the loss component. If this is profitable, then the loss component is 0. If it's unprofitable, then there will be a loss component. And then this part, excluding loss component, as Billy mentioned, there are three different models or approach, but we will focus on the general measurement model. Within the general measurement model, there's also the present value of future cash flow and the risk adjustment. So this is similar to what we have in the LIC. So we will also touch about this, but we will not go into the detail of the PVFCF and the RA. But today we want to focus more on the CSM and the loss component, which is new. Of course, the LRC and LIC, PVFCF and RA is a little bit different. LRC is only for claims. LRC is for the period before the claim. So this is similar to the UPR or the URR. So that of course the PVFCF and RA is a bit different. In terms of the disclosure requirements, we need to. One of the key distinction here is that for GMM we need to split LRC excluding LC and the LC. That means the standard require the loss component to be clearly presented. the rest are actually similar to what we have seen in the LIC. But one component that's not in the LIC is the future service, because LIC is only everything that's happened, service that's happened in the past, just waiting to pay the claims. But future service, if we have a long duration contract, then for example, we can have 3 years, 5 years motor insurance contract. So any claims that we expect to pay that's not within this year will be part of the future service, and in our disclosure, this needs to be split. So I will pass it to Wai Chong to take you through one single example. So we'll start with one sample. Without all the features, we want to get through the concept of GMM, and then I will show you what we need to do if we have a portfolio of like a group of contracts together. Okay, Wai Chong, I pass it to you.
Can everyone see my screen?
Not yet.
How about now?
Well, actually, your video is currently is freezing. Maybe you can turn off the video, the camera. Okay. Oh. It seems that we get lost connection.
How about now?
Yeah.
Okay. Good morning, everyone. So today I will illustrate the one sample policy for this liability for remaining coverage under the General Measurement Model, GMM. So we have two scenarios here. One is the profitable. Another one is the onerous throughout the coverage period. So we assume the premium will be received at the inception of the policy. So what we need to do is open up this spreadsheet and just follow what we do. Then what we need to do is just fill up the orange cell in each tab. Okay, so let's go for scenario 1, which is the profitable contract. As like previously, we have premium 100, and this is to cover 2 years contract. Assume we set the ultimate loss ratio of 50%. Then we need to now set the assumption for this, how we receive the premium, how we pay the claim, and how we earn the expected profit. Okay, so for premium receipt pattern, we assume everything will be received at the inception. So 100% here, 0 here. For claim and CSM, we assume 40% of the claim to be paid at the end of first year, 60% to be paid at the end of second year. Okay, so the same goes to the contractual service margin. So this this contractual service margin systematic allocation ratio we will use later. So we set it equivalent to the claim payment pattern. So now what we need to do for the premium undiscounted cash flow is, like last week, what we do, we take the premium multiplied with the premium receipt pattern. Then we drag it over. For claim, we take the premium multiplied with the ultimate loss ratio multiplied with the claim payment pattern. Okay, then for the net cash flow, we set it income to be negative, outgo to be positive. So our claim is outgo positive. We take it minus with our income premium. And we drag it over. So now we need to do the present value of the FCF, which is the future cash flow at inception. So at inception, to make this example simple, we assume no discounting here. So our discount rate is 0%. So the PV of the future cash flow is sum of all the net cash flow, including the inception. So from here, we see a negative 50. Negative means income. So we have a net income of 50 for this policy at inception. because we are profitable. So this is logic. Now let's go to the PVFCF at the end of each period. Remember, the F here represents future cash flow. So at the end of time 1, we are looking for the future cash flow. So we are summing 30 and beyond. Because we are just 2 years coverage, so we sum 30. We don't include 20 because we are doing future cash flow. We don't need to include the time 1. Okay, so at the end of time 2, we don't have any other net cash flow at time 3, time 4. So this will be 0. Okay. Okay, now let's go through the journal entry. For journal entry, we receive cash at the start of the period, so it will be 100. Then we create a LRC of 100. For PVFCF and CSM, like what we mentioned just now, the present value of FCF net cash flow of 50, which is the net income, is our CSM. So we put a negative to offset the negative sign here. So we have a CSM set up in the liability account. Okay. Do we have any LC here? We are doing profitable contracts, so this will be 0. At the end of the year, do we receive any cash? No. For insurance revenue that come from the PVFCF, how we recognize? We recognize it as our claim. So it will be 20 here. For CSM, we need to release our CSM that we need to use the systematic allocation ratio. So just now we already set a 50 CSM at the start of the policy. So we multiplied with our systematic allocation ratio, 40%. So we will release 20 for insurance revenue from the CSM. So we release total 40. Do we have any LC? This is profitable account, so it will be 0. Okay. Now let's go to the liability account LRC. Like what we did last time in LIC, credit is positive, debit is negative because we are doing liability account, increasing credit side. So at the start, opening will be 0. Initial recognized for PVFCF, this will be 50, but because at debit side, we put a negative. For CSM, we recognize this one, credit side, positive. Do we have any insurance revenue at the start? No, that will be at the end. Cash flow, we receive 100. So at the inception, we have LRC of 100. We carry it forward to the end. We have no initial recognition of at the end of the period. For insurance revenue, PVFCF, we just take it from this number. Okay, because we are at debit side, so we need to put a negative sign. Same goes to the CSM, will be negative of 20. Sorry. Okay, so we left with 60 here of our LRC. So we will continue with the balance sheet and income statement. We receive cash, so we have asset of 100, liability carried forward from our account. Insurance service expenses, we don't have any because this is profitable contract, so it will be 0. So at the end of the year, we continue to have 100 of cash, LRC, take it from LRC account, the closing balance. Insurance service expense, no. Insurance revenue, we take it from our journal entry, which is revenue come from PVFCF and revenue come from our CSM. So we will have a profit of 40. This is at the end of first year. Is there any question? If no, then I will continue with scenario 2, which is the onerous contract. Okay, so for onerous contract, everything will be the same. 100 premium, cover for 2 years. We receive the premium at the start of the period, but our ultimate loss ratio, we change it to 150. So at the start, we already know we need to pay extra 50 to cover this policy. Okay, so we have a loss here. The same, we have premium receipt pattern and claim payment pattern. But now we don't have CSM, systematic allocation ratio, but we have this loss component systematic allocation ratio. How we calculate this, we will skip this first. We will do this undiscounted cash flow first, then only we come back here. Okay, so premium, claim, and net cash flow, like just now, we already do. So I will skip this. To repeat what we did last time, just now, the present value of future cash flow at inception, assume we have no discounting, so the present value of FCF at inception is all the net cash flow, 50. So from this 50 is a positive, so we have net outgo of 50. Like what we said just now, this is onerous contract, so net outgo of 50, this will be our loss component. Okay, so the PVFCF at the end of the period will be 90. At the end of time 2, do we have any cash flow here? Time 3, time 4? No, so it will be 0. Let's go back to this LC systematic allocation ratio. One of the formula we can use is this LC divided by the total outgo. So the LC will be 50. We divide by all the outgo. In this example, it's all the claim. So we sum all the claim. This 33% will be our systematic allocation ratio for the LC. How we use this, I will illustrate in the journal entry. So now let's continue with the journal entry. As usual, we collect cash at the start of the period, 100. PVFCF and CSM, do we have any? We don't have CSM, but we have LC. Okay, so from here, we need to create an LC, and this insurance service expense will hit our P&L at the start of the period because there's a loss here. So we have 50 here. At the end of the period, we will have no receive any cash or pay out anything. Insurance revenue. Okay, let's come back to scenario 1 first. In scenario 1, our insurance revenue will be 20. Okay, we take it from our claim. But in scenario 2, can we do this? We cannot do this because we need to split this insurance revenue together to the insurance service expenses for LC. Now we need to use our LC systematic allocation ratio. Okay, so to give it to our LC, we take the claim for end of year 1, multiplied with the loss component systematic allocation ratio, 33%. So this 20 will belong to our LC and insurance service expense. The leftover will go to the insurance revenue for LRC. Okay, so how we calculate this will be 1 minus the percentage of 33% multiplied with the claim. So this total out will give us a 60 again. So we cannot put all 60 here, also cannot put here. That's why we need this systematic allocation ratio. Okay, and we don't have CSM, so this will be 0. Let's continue with our liability account, LRC. Okay, so at the start, we have 0. PVFCF, do we have any? No. Premium received, we receive it from here, 100. And this, we recognize our LC, loss component, will be 50. So at the start, we already have 150 of the LRC because we need to cover everything, all the claim here, which is 150. Okay. So we carried forward to the end of the year. We carried forward 150 insurance revenue that come from PVFCF, which is this number. But we need to put a negative here because it is in debit side. CSM, we don't have any. For the loss component, no initial recognition, but we have release in LC at the end of the period. How much we release? We release it from this 20. I need to put a negative because at debit side. Okay, so we continue with our balance sheet at the inception. Cash received 100. LRC, take it from closing balance. Insurance service expense in our income will be our initial recognition of our LC, which is 50. So from here, at inception of this policy, we already have a loss of 50. Because this is onerous contract, we will hit the P&L 50 at the start of the policy. Okay, not like the CSM, we'll release it slowly. To the end of the year, we continue to have 100 cash. LRC, take it from our LRC account 90. Insurance service expense will come from our journal entry. Okay, which is here. Expenses increase in debit side, decrease in credit side. So we need to put a negative here. Insurance revenue come from our journal entry for the PVFCF 40. Revenue credit side. So at here, we see we have a profit of 60 at the end of the year. This maybe sound not make sense to you, but this 60 is only within the LRC account. This is only within the LRC account. If we combine last week LIC account with here, this is actually to pay for the LIC claim. So this 60 will pay off the claim, then we will have no profit or loss at the end of the contract. Is there any question?
So far, there is no question. Wai Chung, you can continue. Probably in the end of session, we will receive the question from the participant.
Okay, if no question, then this is the overview for the two example. I think this is quite simple. You can have a look here. If no question, I will pass it to Pak Ronald.
Okay, thank you, Wai Chung. I think we will continue to Nicholas. Or you want to have a break around 5 minutes, Nicholas?
Pak Ronald, we have a 5 minutes break?
Yeah. Okay. Yeah. So right now is 10:39. Probably we can start again in
10:45?
Yeah, 10:45. Bapak Ibu, kita istirahat sekitar 6 menit ya. Bapak Ibu toilet break. Nanti jam 10:45 kita mulai lagi. Okay, thank you. Yeah. Ya, Bapak Ibu, kita balik lagi ke webinar ini. Nicholas, I think you will continue the webinar.
Yes,
Yeah.
yes. No, I will
Yeah,
continue.
okay.
Okay.
Please, Nicholas, you can continue.
Okay, so this is the second spreadsheet that we will be sharing today. So this is for one whole class of business. It is a little bit more complex than what Wai Chung has showed you, but also we had to make some simplifying adjustments so that we can continue and complete the whole spreadsheet today. So there will be so that we have put together the input, and then there will be 5 steps for us to set up the LRC account that is profitable, and another 5 steps to set up the LRC account that is unprofitable or onerous, which will have a loss component. So what are the inputs that we need? Similar to LIC, we need the discount rates for current year and previous year. So what we are saying is we will want to do this evaluation as at the end of 31st December 2020. So let's say for this group of policies, the premium amount is 9,000. The inception date is 1st of January. So for general insurance company, normally there will be a big tranche of business with the renewal at 1/1. So this will be one group of policies. For like the other group of policies, sometimes you may want to have a average inception date at the middle of the month. This one is the objective of this is to pick up a suitable discount rate. So in this case, we have a sample policy of 3 years, and then a risk adjustment. We set this as 20% of total outgo. You can think of this like a PAT, or you can also use a cost of capital approach. And one of the things that we need is actually this CSM systematic allocation ratio. Just now during the break, there was a question on the LC loss component systematic allocation ratio. So the objective of these two systematic allocation ratio is because we have set up an amount, a liability provision, and we need to have a way to reduce this provision to 0. So this is why we need this systematic allocation ratio. So we are supposed to populate this amount here, but I will do this in step 2. We go to step 1 first. So what I've put together, the first step is to prepare the undiscounted cash flow, and we want to project the expected future cash flow and the risk adjustment from inception. So in this case, we expect to receive a premium of 9,000. I put it in negative so that we can add them up together with the claims, which is set at positive. Along with the claims, in addition to the previous example, we introduce a management expense. So let's say this is a single premium policy. The loss ratio is 67%. So add up, the claims are 6,000 over 9,000 is 67%. But we have a management expense, which is spread over the 3 years, and we also expect some claims handling expense. I've not put the commission here. This commission, the treatment of this commission, to some extent is similar to the expenses, but there's actually a deferred acquisition cost item that we need to deal with. So in this simplifying example, we don't have the commission first. So what we need to do is that we sum up the inflow, we sum up the outgo, and then what we want to do is we want to calibrate this risk adjustment. So in this case, we have set the assumption that the risk adjustment is given from the input tab, and this is a percentage of the 20% of the total outgo. Yeah. So we take this multiplied by the outgo. Oh, sorry, I forgot to log in this. So if the claims and expense is uniform, then I think in general we can have a risk adjustment that is rather uniform over time. So this is for this 412 is the risk adjustment which we attach to the cash flows in the first year. Yeah. So once we have prepared this on an undiscounted basis, the next thing we actually want to do is to perform discounting, or more specifically, we want to do the discounting at inception. So first step, after we have done the prepared all the cash flow, we want to calculate the discounted cash flow from inception, from the first day. So we have taken these rates from this input tab, column G, which is at the end of the year, so commensurate with the inception date, which is the start of the policy. So we want to discount everything to the inception date. So this is the first step. The reason we want to do this is because we need to calculate this CSM, or this contractual service margin, at the inception. So what we need to do is, first we want to prepare the discount rate. Here we are using a forward rate. It's a bit different from what we have done in the previous example, which is to use a spot rate. But I think this concept is not difficult. The only thing is the interest accretion will be calculated in a slightly different way. So then with this discount rate, what we do is we bring back the cash flows that we have calculated in step 1 and the risk adjustment. So we want to have the present value of the future cash flow and also the present value of this risk adjustment. Okay, so what we need to do is we need to apply discounting to the cash flows. So in this case, actually what we have done is we have assumed that the claims and the expense actually happen at the year. So 3390 is the present value of the future cash flows. Remember we said 9,000 is a premium, 2,000 is a claim, so the rest is expenses and discounting. So we expect a present value future cash flow of 3,000 and thereabout, yeah. And then we also do the same thing for the risk adjustment. So with these two, basically we have when we add this up, basically is the profit. So this is the contract. This is the contractual service margin, but we have to give it a negative sign. So on the first day, we expect to make 3390 profit when we write this group of business. However, there are some uncertainty to the business. So 1121 is the risk adjustment. So after the risk adjustment, 2268 is actually the profit. However, we cannot recognize all this profit immediately. So we need to have this contractual service margin mechanism, which is supposed to deal with this and allow the profit to emerge over time. So earlier I mentioned that to do this, we actually need to have a systematic allocation ratio. So let's go back to the input. Now what we want to do is, this is a 3-year policy, right? So we want the profit to emerge over the 3 years. This is up to us. The standard don't really prescribe how this systematic allocation ratio should work, but it's just that we want to have a way to actually deal with this properly. So in this case, what I want to do is we use a half-life type of formula. So we take 1 divided by maximum of 1. So the biggest is 1. Sorry. One divided by the maximum of 1. C, this is a policy term, minus the duration plus 1. So let me lock this thing in. What do I want to do is I want to make sure that the systematic allocation ratio will behave like a half-life. So when in the first year, when there are 3 more years, we want 1/3 of the profit to emerge, and then 2/3 of the profit to remain in this unearned portion. In the second year, what happens is that only left year 2 and year 3. So we want to have 50% of the remaining profit actually come out and 50% go to year 3. By year 3, actually, we expect the policy to end, so we can have all the profits emerge. So this is why we have this formula. The objective of setting it up is so that if you have $100, $33 will come out in the first year, $33 will come out in second year, and $33 will come out in the third year. So if we go back to step 2, which I've set up this pattern here. So what we need to do is to deal with the CSM. There is 2 parts. One part is actually the interest accretion. Because we have set up this CSM, this 2268, this is using a discounted basis. So every year, as time passes, this CSM will increase with the discount rate, and then it will reduce with the systematic allocation ratio. So this is our opening balance, and then we will multiply with the discount rate. And then the next part, we want to reduce the CSM negative. So opening with the interest added, but then we want to reduce it by 1/3. So if we do this, over time, basically 2268 is the starting point, plus the interest. This is reducing because the opening will reduce every year because we have this release, and on average about 800 plus will be reduced from this 2268 because 2268 plus the interest, and then we need to reduce this over time. So once we have this formula set up, the 2268 profit will get released over time, and then it will become 0 when the policy is finished. So this is the first thing that we need to do for the GMM. We need to set up this CSM account. So once we set up the CSM, which is this 2268, we need to have a way to reduce this over time. Okay. If you look at your spreadsheet down here, there's another part which is for the loss component. We will only do this in the next part when this is a loss-making group of policies here. So once we have dealt with this CSM, only the orange color part is the CSM here. We go to step 3. Step 3, we want to calculate the discounted cash flow at the valuation date. So the valuation date is 31st December 2020. The inception date is 1st of January 2020. So 1 year later, we need to get back the cash flows that we have. So from the valuation date, we only have 2 more years. We have 2 more expected claims and the cash flow, and then 2 more years of risk adjustment. For the discounting factor, we can use the same formula, but the difference is that what I've set up is that at the valuation date, the discount rate has changed to 4%. So this change in discount rate will only affect the PVFCF and the RA. It is not going to affect the CSM because the CSM is done at inception here. So when the discount rate changed from 4% to 5%, from 5% to 4%, we do not actually recalculate step 2. Okay. So what we do is we have the same discounting, but then we only apply this prospectively from the valuation date. So we have this 3885, which is the present value of the future cash flow. We call this the closing balance because this is the remaining cash flow, which is the 2,000 claims for 2 years and the $60 of the expense, and then discounted with the 4% discount rate, and similarly for the risk adjustment. So once the discount rate has changed, what we need to do is we need to quantify the change in the discount rate, because this part of the change in discount rate will actually go into the insurance finance expense. So we take the same cash flows, but then change the discount rate is now 4%, not 5%. And the change, so this would be what if we had discounted at 5%. So now we are discounting at 4%. So we want to take the difference, yeah. So this 55 and this 11 is the difference from using the different discount rates for both the PBFCF and the RA. Okay, so I think this part is very similar to what we've seen last week in the LIC. I think this is nothing new. So, but what we want to make sure is that we remember that in this step we actually don't do anything about the CSM. And then the next step, what we want to do is we need to calculate the subsequent change, right, and the interest accretion. So as we have seen from Wai Chong's example just now, so the objective of this change, right, is so that we actually get the expected cash flow over the period. So because this is the outgo over the period and the risk adjustment. So this subsequent change, right, will happen to our PBFCF because 1 year has passed. So previously at inception we discount the whole cash flow, but here in step 3 we only discount for the remaining 2 years. So we have this outgo and the risk adjustment. The other thing that we want to do is we want to calculate the interest accretion. So how do we get to the interest accretion? So basically we have to extract this amount from step 2. Yeah. So we take from step 2 C6. So this is the present value of future cash flow as well as the premium. So what do we want to do is we put this into a bracket and then we multiply this by the interest rate, because 1 year has elapsed here. So we take the present value of the future cash flow, subtract the premium, which actually happens on the first day, because this is our assumption, and then so the premium does not have any interest accretion attached to it, and then we multiply this by the interest rate. For the risk adjustment, because there's no premium involved. So we basically take the risk adjustment multiplied by the forward rate. So this will become our interest accretion. So this is the impact of just the time value of money. Nothing else has changed. There is a question on the RA in the group. I will answer it, I think, after I finish a few more steps here. So basically, in step 5, what we want to do is we actually want to get the premium received, which is 9,000. The reason we want this is because we want to prepare for the accounts. Yeah. So then we will go to our LRC account. Okay, so what happens is that in this LRC account, so we will go through the steps. The first step, we actually want to fill up the initial recognition of the present value of future cash flow and the risk adjustment from step 2. So when we actually write this policy, what we do is that we will fill up the initial recognition of PBFCF and RA. This is the first thing that happens when we recognize this contract. Okay. So the next thing we do in step 3, we want to fill up the closing balance here of the PBFCF and the RA. So what actually happens here is that we have the closing balance. This is the future cash flow as at the valuation date, and all the future risk adjustment discounted at the valuation date. So this is how much future cash flow and risk adjustment we still have. Okay, so then this is the starting point. This is as at the valuation date. So the next thing we want to do is we have to fill up the change in discount rate, and then we want to fill up change in discount rate and this interest accretion. So this tool is actually similar to what we have done in the LIC as well. What is actually different or more specific to GMM is the subsequent change in the PBFCF and the RA. So this part, right, is actually the insurance revenue. So how to look at this is that the expected claim over this period and the expected expense is 2060, and this risk adjustment is the 412. So this is like why is this part of the revenue? Because this is the part of the cost. This CSM, which I'll explain later, this is the part of the profit. So when you have cost plus profit, then you will actually get the revenue. Okay. So what we need to do is fill up the initial recognition, fill up the subsequent change or the expected claims, expected expense, and risk adjustment, fill up the interest accretion and the change in discount rate, put in the actual premium received. So when you receive premium, you will actually increase the LRC account, and then you have the closing balance over here. So all this should tally properly. So the part that I have not yet explained is actually the CSM. So outside of this LRC account, there's actually a CSM account. So what we need in this CSM account is the initial recognition of the CSM, a release in the CSM, which we have calculated using the allocation ratio. And then we have this interest accretion, which we have calculated in step 2 just now. So with this, we actually have a CSM closing balance, which actually forms part of this LRC account. So when we put in all this amount here, then the LRC account will be complete. And then now let's look into completing the journal entry. So we have a premium received of 9,000. We have an initial recognition of the PBFCF. Sorry, this is a debit, so we have to put a negative. The RA is a positive, so we can credit it. So in this example, we have no loss component. So when we do the change in the subsequent change in this PVFCF to get to our insurance revenue, and also the risk adjustment. And over here is also the release in the CSM. So all this is actually our insurance revenue. Yeah. So in this case, we have 2060 plus 412 plus 739, which is the insurance revenue. So if you add them up, this is a 3,000 plus. So it reflects more or less. Remember, this is a single premium 9,000 divided by 3. Yeah. So then we have the insurance finance expense, which is the change in the discount rate for both the PVFCF and the RA, and also the interest accretion, right? So again, no LC. So these are all the entries that we need. Premium received, initial recognition, if the policy is also within this valuation period. We have insurance revenue, change in discount rate, and the interest accretion. So the next thing we want to do is we want to complete the income statement and the balance sheet. So the change in current service. So all this is the current service from the insurance revenue and the CSM portion. So this gives us a total insurance revenue of 3,265. On the expenses side, there is an initial recognition of LC and the release of LC, but this is profitable, so there is no expense at inception. So the only thing we have is the interest accretion and the change in discount rate. So the interest accretion will just be the sum of these three amounts. The change in discount rate is here. So the main difference from IFRS 4 to IFRS 17 is that the revenue is now 3,000 and nothing much to do with this 9,000 premium received. This 9,000 premium received just goes into the cash. It does not make its way into the revenue. And then the closing balance of the LRC, which is the PVFCF and the RA, and then we have the CSM. Yeah. So in this case, what happened is that again, this is not the complete income statement and balance sheet because the claims part is not included here. The claims part is in the LIC, but without the claims, basically we expect to make a profit of 2,700. This is mainly because we expect the revenue that we have put together. This revenue here, 3,265, because it included some of the discounting inside, and then part of it is reflected out in the cost here. Okay, so I think this is the part for the profitable contract. But Ronald, should I continue or should I take some of the questions?
Up to you, Nicholas. Which one do you want? If you want to answer some question, it's okay for me.
Okay, maybe I try to take some of the questions.
Okay, I will read it. I will read it first, yeah, Nicholas. Okay, the first one from Pak Ivan Faisal, regarding to risk adjustment calculation model, since the methodology has not been standardized yet. According to your opinion, could we use probability of claim occurred multiply with average claim amount to get RA amount, whereas probability of claim occurred derived from average of loss frequency divided by average of policy number? Please, Nicholas.
I think when you set the RA, depends on the class of business. Some class of business is a high frequency, low severity. So when it's high frequency, you have a high credibility. I think no matter how you do the RA, you should be able to get a good distribution and a lot of the data to choose from. But the problem is when you have the high severity, low frequency. So then if you use a number of average claim amount, this amount actually can change quite a lot in different years. So when this happens, actually maybe some of the statistical method cannot apply, and you need to apply some judgment to override some of this. But in the spirit is that this risk adjustment need to reflect the uncertainty of this estimate. So we have this estimate, this PBFCF. As long as we are confident, that we add this risk adjustment, it actually shows the reader of the financial statement that this reflects uncertainty. So for example, I have here this risk adjustment is 777, the PBFCF is 3885. As long as you are satisfied that the reader can look at this and they know that that means the PBFCF can easily be 3,000, can also be 4,500. Then I think they should be satisfied. So that normally companies use a value at risk approach or a cost of capital approach to do this. But when you do the value at risk approach, then you can choose whether you want to use a number of claims or average claims, because for LRC, the methods to derive this RA is not so established, but for the LIC, there are methods like all these MAC methods, bootstrap methods, which can help us actually do the risk adjustment.
Thank you, Nicholas. So and then the second question is from Bu Purwani, Bu Iwin. Hi, Nicholas. How to determine the claim distribution in a common practice for PA and GMM?
Oh, okay. So I think this one is this is maybe something that's very subjective. For my side, the starting point is normally a log normal distribution. The reason is because this log normal distribution, first is like it has the properties that are suitable for claim. So it's a continuous distribution, non-negative. So for example, it's very hard to use normal because it's negative. It can be positive and negative. And what happens is that when we use the log normal distribution, we actually have two parameters, the mu and the sigma. The combination of this mu and the sigma can give to many possibilities. So normally this is our starting point, and the concern is like this. So in the past, we always do a 75th percentile. When we do 75th percentile, we use any distribution, it wouldn't be too far away. So if you use a log normal distribution, a gamma distribution, Pareto distribution, the results will be similar. But if you are looking further to the tail, like you are looking for 99th percentile, then a different distribution actually will give you a very different answer.
Yeah. Okay. Thank you, Nicholas. And then the third question is how to generate a CSM allocation ratio. Should we generate it from a policy level? Oh, sorry, from Bu Feni Astrini. Please, Nicholas. How to generate? Yeah.
So normally the CSM is calculated for this group of policy, and then you also, because is like a group of contracts, right? So you need to reduce the CSM for this group of contract to 0 eventually. But for the practicality of the calculation, sometimes some companies has a model which is based on one whole group of policies. Some company has a model which is based on individual policy. So if your model is based on the individual policy or the individual transaction, you need to find a way to allocate downwards or upwards, right? So that the CSM for each of your policy and the CSM for your total group is actually the same. Then the whole calculation will work. This is more of a practical thing. Because because sometimes the trouble is that the reason why I also do this CSM allocation ratio like this, if you see what I have here in my input tab, right? The reason also I try to do something like this and then still leave it with 100 is sometimes it's not to say that every group of policy exactly have the policy term of 3 years. So sometimes there may be an extension again into the next year. Sometimes the policy term is different, yeah. So we need to find a way so that this ratio actually can deal with some of these problems. So if suddenly, if you have 100 policies, 99 of them has 3-year duration, one of them has a 5-year duration. So this is where you need something like this to deal with it on a group level, and then we'll still work in a policy level.
Yeah. So is it okay to if we use it? I mean, we can use a uniform allocation, Nicholas.
It depends on the type of the product and the type of the risk. So if the risk is uniform, then the CSM is uniform, there is no problem. The CSM need to reflect how much risk there is, because this thing determines how much profit you will get at each accounting period.
Yeah. So for example,
once the risk has finished, then you get the profit.
So for example, in a credit insurance, probably in the early years, probably you can set aside the CSM just a little CSM in early years. Is it right? Or because the risk is higher in the early years of credit insurance?
So for credit insurance, it's like you are referring to like a loan, because the loan amount is higher in the early years, right? So normally people will try to build a CSM using the sum insured or the loan amount as to reduce instead of reducing over time like this.
Okay. I think one more question, Nicholas, before you start again. How to do LAT for the long-term policy using PA method? So how to do LAT so you can use a PA method?
Okay. So I think if I understand correctly, the question relates to how to perform the PAA eligibility test, right?
Yeah.
Okay. I think that one will be covered in the next session, but maybe I can briefly explain. So because what we will do is that when we are in the step 2, what happens is that we actually can project the PVFCF and the risk adjustment for each of the duration. So for example, at the end of year 1, right? We know that this is the present value of the future cash flow, and this is the risk adjustment. And then we have the same thing for year 2 and year 3. Okay, so this is the LRC as at any point in time. So roughly what happens is that because the claim is 200, is 200 per year, is 2,000 per year. So this is like 6,000, 4,000, 2,000. And then the other unearned profit, this is like starting from 2,000, 1,000. So all these things will actually add up to the 9,000 of premium. So this is what happens. So when you look at this thing at inception using the GMM method, and then we will do the same thing again, but using the PAA method. So if the sum of the PVFCF and risk adjustment and this closing balance of the CSM is similar for both PAA and GMM, then the difference is not material, then we can use the PAA method. So we will cover this example in detail in the next session.
Okay, thank you, Nicholas. Additional question from me, Nicholas. So usually for the common practice, how much the threshold for the difference between the PAA and GMM? So it can be eligible for the PAA. The threshold, the percentage of difference.
The threshold normally determined by the auditor. What I've seen is people try to go to 5% and 10%.
Of GWP or
of the GMM. So there are a few different thresholds. So if this business is very small, so let's say your total business is 100%, but this business is 2%. So 2% of GWP is not material. That's the first step.
Okay.
Then we do this eligibility test. Then we see that the PAA versus the GMM, what is the difference? The absolute difference and the percentage difference. And then we try, and then the rest, what exactly is the threshold is actually a subjective discussion with the auditor. So many people say that PAA is an easier method, but the problem is justifying PAA is very troublesome. So sometimes people do not want to do PAA at all.
Yeah. Okay, so just to make sure, so LAT is a different method. Is not the method used for the PAA eligibility, right, Nicholas? So it's a different things.
LAT maybe is a IFRS 4 type of
yeah. Okay, I think you can continue the material first, and then we can after that we can answer the question. Please, okay. Nicholas. Yeah.
So now I continue to the onerous part. I think what we want to do here is that for the onerous part, I want to set aside a slightly different cash flows. So for simplicity, we don't change the expenses, we don't change the premium. The only thing we change is the claim. So let's make the claim 4,005. So if the claim is 4,005 instead of 2,000, then basically just two years of claims will already be more than the premium. The loss ratio, the ultimate loss ratio is actually 150%. Okay, so when we have this, we no longer have a CSM, but we actually have a loss component. So we want to go to the next step, which is the step 2. So what happens in step 2 is that if we do the same thing, we have a PVFCF and risk adjustment, but we have this formula here that if the PVFCF and the risk adjustment add up is more than 0, we actually have no more CSM. So everything, all these yellow color functions that all these yellow color cells that we put together is no longer relevant. But what we want to do is actually we want to have this part down here, which is the loss component. So the loss component is simply the opposite of this formula. So if it is if the sum is positive, basically we will have the loss component. Okay, so basically on the first day, we will have this loss, which is 4902. Then what do we want to do next is that we want to calculate this systematic allocation ratio of the loss component, and I want to elaborate this a bit more. So the systematic loss, this systematic allocation ratio of the loss component is so that when we look at the financials later, right, the claims will actually and all the losses will actually match nicely. So we take the loss component, divide by negative premium, and then the PBFCF plus the PBFCF and the risk adjustment. So what does this mean? This means that about 40% will need to be allocated to the loss component over time. So this is 100% of the premium. This is the losses, and then this is losses divided by premium plus losses here. Okay, just remember this part first. So 4902 divided by 5902 divided by 5902 plus the premium. Why do we want to do this? We go to the next step. So for the change in discount rate, actually no difference. Everything is the same. So we have the same formula, but then now with this with the loss component, right, we need to do the same part. So because we have closing balance of the PBFCF, but then we also have the closing balance of the one excluding the loss component. So this one we no longer want it. So what is, if 40% of everything goes to the loss ratio, 60%, if 40% goes into the loss component, then 60% must go back into the LRC, excluding the loss component. Okay, and what happens is that we will, the closing balance, instead of this PBFCF, which is the whole thing, yeah, this is based on the whole future cash flows, including the loss part, right? So what we want to do is we want 60% of that to remain in the part that's excluding LC. Because the closing balance of the LC is presented differently, and then this is again the change of discount rate of the entire part of the LRC, right? So we again need to split this to the part that is not relevant to the LC. Okay, so this is why we have this. This is why we have the loss component and the excluding loss component part here. So if we didn't have this ratio, we wouldn't be able to split here, which is a loss component, which is not loss component. And then we go to step 4. Actually, we want to do the same thing. So here we need to have the part. There's two parts here. One part of the subsequent change. So one part of these claims here, this 4,500 claims and $60 expense, one part of it has to be in the release of the loss component. The other part of it has to be in the subsequent change of the PVFCF in the LRC excluding LC. So so we have to apply 40%, this 40% and the 60%. So what is actually captured in the loss component is everything that is exceeding the premium. Yeah. So 40% of the future cash flow and the risk adjustment. So this is a release in the LC, we give it a negative. So instead of this whole thing being a subsequent change in the PVFCF, we only have a 60%. So what we are effectively doing is there's this total of 5472. Previously, this was the subsequent change. Now this subsequent change has to be split, one part into the LC, one part into the excluding LC. We will actually do the same thing for the interest accretion. So 40% of it will go to the loss component, and then the remaining 60% will remain in the LRC excluding LC. So with this, we actually can create this loss component, and this loss component, the split between this loss component and the PVFCF and the RA is done using this systematic allocation ratio. So when we do this, what happens is that all the any cash, regardless of what is the cash flow, as long as we have locked into one ratio, we are able to have a split that makes sense between the risk adjustment, between the loss component and the non-loss component part. So premium received no difference, it's the same. And when you go back to this LRC account, now this is the main difference is this here. We fill out this initial recognition PVFCF and RA, but it's just zero because there's no profit to recognize. So when it's profitable, we recognize the future cash flow, the risk adjustment, and the profitable CSM. Now here there's no CSM to recognize. So basically what happens on the first day is that we actually recognize the loss component, the release in the loss component, and the interest accretion. So this is the main difference between the loss when there's a loss component. So this whole CSM becomes zero. And everything here is no longer 100% of what it was previously. This is only the allocated part of the LRC, excluding the LC. So whatever that's loss making will go to the other part. So in the journal entry, you can see that the initial loss recognition of the LC, which will be here, and then at the end of the year, we can release a part of this loss component. And there will be an interest accretion here. So compared to before, we actually have we actually have an increase in the liability. But at the end of the year, this is the closing balance. And we have the initial recognition, which we have to recognize as an expense. And then we have this release in the loss component. So this is a release, yeah. So we minus the loss component. And then the last part, which is the closing balance of the loss component in the liability to tie up everything here. So here we receive cash. We receive cash 9,000, but our liability is 10,000. So that's 1,000 loss. Revenue recognized in this period is 3,300, but the losses recognized is more than that. Yeah. So that's why we have a recognized loss here. So the main difference is that in the LC account, we will actually put in this loss, and when there's a loss, you can see that this one hits the expense immediately when there's a profit, whereas when there was a profit, the entire amount of the CSM does not actually get anywhere into the revenue or the expense. Yeah, only the release gets into here. Okay, so this is I think I've completed this example. I think maybe we can go back to questions and answer. Ronald?
Yeah, sorry, Nicholas. Okay, thank you for the material. I think this is the end of the material, yeah, Nicholas?
Yes.
Yeah, okay. So we continue with the Q&A session. The first one from Tabah Wisnu. What is the difference between LRC risk adjustment and LIC risk adjustment? Should we use the same data to calculate them? How about the method?
I think the underlying risk for the LRC and the LIC, there are similarities but also differences, right? So I think this is the same. You'll probably already have the same issue now in the IFRS 4. Because very often is that the LIC has all the past accident years, risk of the past accident years, but the LRC is only the tranche of the business that we are writing currently. But sometimes for practicality purpose, right, some of these differences is not so important, and we can use the same risk adjustment for LIC and LRC as long as we are able to explain that the difference is not so material. Normally there is an expectation that we need to, at least in the work we do, we explain why we use the same risk adjustment or why we use a different risk adjustment, because auditor, regulator will ask. If you use the same, they will ask you why you use the same. If you use a different one, they will also ask you why you use a different one.
Okay. Yeah. Is it common, Nicholas, if we saw it right now? Usually, some of us multiply the risk adjustment for claim with 1.5 for the premium risk adjustment. Is it common for the IFRS 17?
So 1.5.
Yeah.
So that means you use a subjective judgmental factor. Yeah, I think these practices will continue into IFRS 17. The issue is how much data do you have. So some portfolio you have data, you can calculate your risk adjustment in a technical way. But some lines of business, maybe this line of business is very small in your company, or some line of business, for example, like aviation, you don't have a lot of claim experience. So we still need this type of subjective method to do it.
Okay, thank you, Nicholas. And then the second question from Tabah again: should the model and aggregate level be the same between LRC calculation for booking purpose and eligibility purpose? Can we use the simpler one for the eligibility test purpose? I think some of us are trying to make the PA eligible, right? Yeah. For example, like this, we try to make the higher contract aggregation with the compared to the calculation.
Okay, so the reason we want to do PAA is because the idea is that PAA should be simpler, or PAA will have a less change in the system, change in the calculation. So the objective, of course, we also want to have the eligibility test simpler, because if the eligibility test is so difficult, then it defeats the purpose, because effectively you have to do GMM and PAA. So for example, if you do your PAA eligibility test, it can be based on one sample. You don't have to calculate the whole. You don't have to calculate the whole portfolio.
Oh, I see.
So you can, because PAA eligibility is a modeling thing, whereas the actual calculation, the financial reporting, is the whole company. You don't have to do PAA eligibility for every single policy that you have. This is not supposed to be the objective here. The objective is to ask whether PAA and GMM, is it materially different. So if you use a sample, you have already proved that it is not materially different, then there's no point doing everything in the very detailed way. But what I'm motion is like this: if the PAA eligibility test is not done well, what happens is that suddenly, maybe halfway through your implementation, the auditor say it cannot. We need you to do GMM. Then you have a problem. Or even next time, maybe the contract start as a PAA, but halfway you have to de-recognize PAA and then make it a GMM. Then this will become a very big problem. So I think, yes, definitely you can do a simpler one. I think the point is not whether simple or not, is whether this thing is robust and well documented.
I see. Okay, Bapak Ibu, is there any question? Ada lagi pertanyaan? Silakan, mungkin ditulis di Q&A. Kalau ada pertanyaan juga.
Maybe I also elaborate. Maybe like the Persatuan can help some of the companies, because different auditor, different company have different threshold of this PAA eligibility, right?
Yeah.
So we'll come together and share some information, share some knowledge on how they do. Then maybe everyone can converge to a standard practice, so that there won't be so much confusion. Because currently there is still confusion.
Yeah. You're right.
Ask people to do different things, for example.
Ada pertanyaan lagi, Bapak Ibu, silakan. Mungkin juga ada masukan atau apa, silakan. Atau mungkin ada pertanyaan dari sesi yang pertama, silakan juga kalau ada untuk LIC. So Nicholas, while we waiting, so for next week, what is the material for next week for the third session?
So the next week we will go through an example of the PAA, and then we will merge the PAA and the GMM together, so that you can see how the eligibility test can be performed, or one way of how we can perform the eligibility test.
Oh yeah, I see. So next week we can perform PAA eligibility by ourselves, right?
Yes.
Yeah. Bapak Ibu ada pertanyaan lagi? Kalau tidak ada pertanyaan, boleh diisi presensinya Bapak Ibu sebelum meninggalkan Zoom. Selain itu, mungkin kita bisa foto bersama terlebih dahulu. Pak Yosep, boleh tolong Pak? Bapak Ibu boleh menyalakan kameranya ya untuk foto bersama untuk dokumentasi.
Ya, silakan
Ya.
di kameranya. Oke,
Ditunggu Bapak Ibu.
ya, saya mulai saja terlebih dahulu. Ini ada 6 slide Pak ya.
Ya.
Jadi ada 6 kali kita untuk sesi foto ini. Oke, kita mulai dari yang pertama. Semuanya senyum. 1, 2, 3. Ya. Sebentar. Oke, yang kedua. 1, 2, 3. Oke, sebentar. 1, 2, 3. Yang ketiga, 1, 2, 3. Oke, thank you. Yang keempat, waduh, masih banyak yang belum buka nih. Oke, dibuka dulu. Semuanya Bapak Ibu. 1, 2, 3. Oke. 1, 2, 3. 1, 2, 3. Ya, terima kasih sudah
Ya.
Pak Ronald.
Okay. Nicholas, Billy, and Wai Chung, thank you for your time. Bapak Ibu, terima kasih untuk waktunya juga. Jangan lupa untuk mengisi presensinya. Lalu Bapak Ibu juga kalau nanti minggu depan kita akan dikirimkan juga untuk link yang template yang sudah berisi formula. Selain itu, minggu depan adalah sesi terakhir, sesi ketiga untuk IFRS 17 measurement ini. Jadi kalau bisa Bapak Ibu menyiapkan pertanyaan-pertanyaan sebanyak mungkin untuk ditanyakan pada sesi terakhirnya, sehingga nanti kalau ada yang masih yang bisa kurang kita mengerti sekarang ini bisa kita tanyakan nanti minggu depan, gitu ya. Terima kasih Bapak Ibu untuk kehadirannya. Sehat selalu. Sampai ketemu lagi minggu depan. Terima kasih. Selamat siang.
Terima kasih. Selamat siang.
Terima
Ya,
kasih.
terima kasih.
Selamat siang.
Iya,
Selamat siang, terima
Mohon
kasih.
izin, Mas.
Terima kasih semua.
Selamat siang.
Salam sehat
Bu.
untuk
semuanya.
Semua
Sehat-sehat selalu.
yang izin live.
mohon izin live.
Terima kasih.
Terima kasih, Pak Ronald.
Terima kasih Bapak Ibu.